We believe that domestic consumption in emerging markets will play the most critical role in global economic growth in the future. We are already witnessing emerging market becoming the largest consumer globally. However, it is still in the very early stage of the long-term growth path. Considering its huge population, younger demographics, low penetration, and higher and steadier income growth and other technological drivers. Our Global Emerging Market Grey Consumer Fund invests in the beneficiaries of this multi-decade megatrend. We approach this consumption thematic strategy beyond the traditional consumer sectors. Based on our bottom-up research, we invest in the beneficiaries of consumption growth across sectors. It is a benchmark agnostic and high conviction portfolio with about 50 to 55 high-quality companies that we believe are run by capable management who can deliver strong business results for the next several years.
We see powerful structural opportunities as EM economies shift away from asset-heavy, low-return industries such as manufacturing, construction, or commodities, and towards services, innovation, and high-return business models. This shift creates higher-paying jobs and increases discretionary income, which should lead to higher standards of living and a shift in spending patterns to healthcare, education, luxury, travel, experiences, and much more. More spending in these areas amplifies the shift and ultimately translates into a domestic, consumer-driven, self-fulfilling cycle. In regards to our investment philosophy, we run a concentrated portfolio of high-conviction ideas based on multiple drivers of growth, sustainable competitive advantages, aligned management teams, clear catalysts to drive earnings revisions, reasonable valuations, and consumption. Our strategy retains an underweight position in materials and energy, which minimizes uncertainty, reduces volatility, and improves risk-adjusted returns. In regards to our process, our team follows a strict and repeatable 4-step investment process. The first step is a quantitative screen, which brings the 40,000 plus names across emerging markets down to roughly 3,000. This screen is based off business, financial, and liquidity risks. The second step involves analysts conducting fundamental research and building their own sector-based recommendation lists. These lists are tracked versus their respective benchmarks to ensure that analysts, portfolio managers, and investors have a clear and strong alignment of interests. The third step requires the team to collaboratively create a model portfolio based off the highest conviction ideas from the analyst recommendation lists. The final step is portfolio construction. Here, the portfolio managers, with input of risk guidelines and the model portfolio, build a high-conviction, concentrated, and high-return portfolio based on bottom-up analysis and structural themes.